Welcome, everyone. Thank you so much for joining us today, probably on your lunch hour. We are today talking about the do's and don'ts of due diligence. And I've had the pleasure of taking a course with Cory over the last few weeks. He has a fantastic multifamily course that I've been really enjoying following along and picking up gems here and there from Cory and his guests that he has on. So I thought it would be really great. I know there's a lot of us right now that are either getting into the multifamily space because some of the changes in the market and the economy and that kind of thing, or maybe some of us are already kind of in the smaller multifamily space. We're looking to upgrade to the bigger multifamily space. So I thought this would be a fantastic opportunity to be able to talk with Cory a little bit more about the do's and don'ts of due diligence. And the reality is the last couple of years as investors, we've probably been making some decisions that are more emotionally based. We've gotten in the mindset of, having to go in with no conditions, having to make decisions really quickly, having to say, can I figure out a way to make this problem work? And the question we generally should be asking ourselves is, do I want to buy this seller's problem? So Cory's here to help us kind of reframe and get more back into the proper thought process that we need to have when we're in a more balanced market, where we're deciding, do I want to buy this property versus how much am I offering because I'm desperate to get this property under contract. So really glad to have you joining us today, Cory, for this awesome webinar. Our agenda today, thanks, Cory. Our agenda today, I'll do a quick welcome and introductions. Cory, of course, will do his presentation. We'll follow up with a Q&A period. And then my aim is to wrap up just about at 1 o'clock so that we let you guys maybe grab a chance to get a coffee and get settled before you go back to work for the day. Just a quick reminder, I know after 2.5 years, most of us probably know Zoom, but just a reminder how I run my webinars. When you're typing in the chat box, make sure you can see, oh, there we go over here. When you're typing in the chat box, make sure you click on the drop down and change it to everyone, because otherwise Zoom defaults to hosts and panelists. So Cory and I are the only people who see your comments and responses to any questions that he asks. If you have a question for Cory, Cory, we haven't really chatted about this. Are you okay if everybody holds questions to the end and lets you kind of get through your presentation, and then we'll go through everything one by one?
It works for me.
Okay, fantastic. So then please, guys, use the Q&A tab at the bottom. It's different from the chat. If you ask questions in the chat, they will probably get lost throughout the term of the webinar. So use the Q&A tab, type in your questions, and then Cory will answer as many as time permits when he gets to the end of the webinar. I, of course, am your host, Elizabeth Kelly. I'd like to thank you so much for joining us today. Always love to see you guys. I know we're coming into the nicer weather. We're coming up to summer, so there's a lot of other things you could probably be doing, including eating lunch outside. But thank you so much for taking the time to join us. And our guest today, of course, is Cory, who is a successful real estate entrepreneur. He's also a coach. He's been involved in real estate in an investment capacity for 22 years, and he specializes in multifamily. So hard to think of someone with more qualifications to be able to come and talk to us about our thought processes and what we need to be looking for during the due diligence process. Cory has actually purchased 10 apartment buildings in the last decade with a value exceeding $25 million, and he particularly specializes in prairie real estate markets, which is a great place to be these days because we both know Ontario and BC are super hot. So we're going to, without any further ado, we're going to bring Cory on. And thank you so much for joining us today, Cory. We're really happy to have you here.
Thank you so much for that intro, Elizabeth. And 22 years there's a pile of mistakes, but I don't obviously don't have time to get into them all here. But I've focused on some of the key ones that I think your audience is going to take a lot away from this. So I'm ready to share if you are. So I'll just share my screen.
Go ahead.
Here.
You should be good to share.
Okay.
And I'll give you a thumbs up when we can see.
See that?
Yep, we see the view with the slides down the left side.
Okay, here we go. Here's the presentation.
There you go. You're all set.
Okay, so who am I? I've been doing this real estate for 22 years, as Elizabeth said, and 18 years of that has been in multifamily. So I'm an investor and I'm also a coach. So I also teach multifamily courses. But first and foremost, I'm an investor. So for me, the words due diligence, it starts at the pre-offer phase. So I think the scope of this presentation is going to be investment type, not homeowner. I know we're talking about adjusting markets, but so this is sort of focused on investments. So, you know, my diligence starts at the pre-offer and it ends at close. So it's a continuous process throughout the whole buying. Now, why do we do due diligence? You know, the first reason is you want to protect the money, whether it's yours or JV's, and it's to validate your deal. Is this deal actually good? Can I actually make money off of this? So protection is priority number 1, 2, and 3. And this goes double for joint ventures. It's perfectly fine to lose your own money. I've lost a lot of my own money. It's not okay to lose other people's money. So the first question you have to ask yourself is, you know, am I willing to do everything to protect the money? Or can I find that help somewhere? So validation comes down to, you know, is this a good deal or not? So fortunately, in multifamily, you're not in it alone. I'm not buying a single family where it's dependent on the appraisal of my neighbor. You know, I have a lot of people with me on my team. You know, my property manager, mortgage broker, mentors. I have a whole handful of people I can bounce my deals off of to tell me if it's good or not. And, you know, that's one part of it, as well as you want to really verify all your numbers, you know, figure out your upside. And there's a lot of factors involved in the purchase. So the first thing you want to look at is, you know, risks. What are the risks when we begin to look at diligence? So I kind of break this into 4 categories. Negative cash flow is a huge one. And acquisition risk on the buying process, operation, you know, while you own it, and disposition when you go to sell it. So alligators, you know, we've all heard this term, negative cash flow properties, you know, an immediate threat. We need to deal with this like immediately. So a few causes of negative cash flow, you know, this can happen with single family as well. You know, it's actually more so with single family. If you have turnover, you're 100% vacant. With multifamily, you know, we get high turnover for a variety of reasons. Some people, they over leverage. It's very easy to do that today, even though we are now in a rising interest rate environment and lenders are actually scaling back their loans. So this is actually making due diligence for investors even more critical. So we have market risk. You know, what markets are we going into? You know, you can have vacancy spikes in certain markets. If you have single industry towns, smaller towns, there's different levels of risk. So maybe you didn't do your analysis at purchase, or you don't have any money. So you go into the purchase, you scrape together enough to buy the property, and there's always things you need to do, and then you don't have cash to fix them. So that's some pretty high risk positions you can find yourself in. So the consequences of this is, well, you have to lower your rent. You may not be able to renew your mortgage. So if your term is coming due, you might not be able to remortgage, and that's a very bad position to be in. And you also might have to be subsidizing it every month out of your own pocket. And, you know, been there, done that. And when you're doing that with, you know, 3 or 4 apartment buildings at the same time during COVID, it can add a lot of stress. And it forces you to become a motivated seller. You know, no one wants to be a motivated seller. So there's ways you can mitigate negative cash flow risk. In my opinion, you know, we used to do 5% of the asset value as a reserve fund. So on $1 million property, that's 50 grand, you know, 200 grand on a $2 million property, which is your standard 20 suite apartment building. You know, I've since increased that to 7.5% reserve fund, simply because on a 5-year hold, you're going to need it. You know, I see a lot of these pro formas with cash flow analysis. We're going to get this much every year. Well, on a highly levered 40-year-old apartment building, it rarely works out that way. You really need to do your homework at purchase. And if you have a good property manager, you know, you want to listen to them. If they tell you you need to spend X amount on your suites to rent it at a certain amount, that's what you have to do. You want to be careful going in. You don't want to pay too much, and you don't want to take on too much debt. And you want to address the deferred maintenance items. So on this webinar, I'm really going to be talking about deferred maintenance and the property condition report, or the building condition report. And you want to know what cycle you're in. So right now, for example, you know, on the prairies, we're entering into a really hot market. Vacancies are coming down, properties becoming more expensive. Now, if you've been in Ontario or British Columbia, we've had a hot market for a long time with low vacancy. So it depends what market you're in. And the niche. So, you know, whether you're in a large city, you know, whether you're in Vancouver, whether you're in Surrey, you know, or whether you're, you know, maybe in Nanaimo. So different areas have different risks. Acquisition risk, you know, I kind of talked about this a bit already. Obviously, we don't want to pay too much. Deferred maintenance is critical in multifamily. And every veteran I talk to, no matter who it is, they could have 30 years experience. So bites everybody at some point. There's a ton of deferred maintenance with multifamily. And if you bought in a bad location, maybe you're out of town and you bought in, a high, it's the Black Triangle of Edmonton. Maybe you didn't know where you were going. I've seen a lot of people fall into that trap, and then you end up with high vacancy and some problems. So there are risks when you own it too. There is such a thing as overspending on your upgrades. You can do a really high-end upgrade in a rough neighborhood and just basically have your building trashed 6 months later. So you want to be careful what you spend. You want to have someone on the ground who's managing your building who really has a lot of experience. You want to make sure your compliance is up to code. Fire is just one example. And you need to adjust to the rental market. We had vacancy spikes in Alberta and Saskatchewan where I was slow to respond. Landlords were lowering their rents, and I was stubborn and I kept my rents high. I ended up turning over most of my building and doing renos instead of just offering my existing tenants incentives. So that's a great example of, having to adjust to the market. So disposition risk, again, if you fall into the negative cash flow trap, you could become motivated. There is a lot, and I mean a lot of multifamily buildings for sale right now from motivated vendors because they don't have money to fix problems or they just don't want to. And also at term, they're coming to investors and saying, people that thought they could refinance at 2%, now they're staring down the barrel of 4% for CMHC, realizing they can't even renew their mortgages. So the bank is saying, hey, Mr. Owner, you now have to pay down your loan by $200,000. So people are falling into that situation. You don't want to have that happen to you. And you don't want to have to sell in a down market either. So those are positions you don't want to find yourself in. So after 20 years, and talking to a lot of people, I've kind of put together some patterns, with due diligence on apartment buildings, because once you've owned it, it's too late. Once closing date is, you find you pay too much. You might have bought a property that, someone sophisticated wouldn't buy. You didn't negotiate properly. You don't have your team in place to operate it, or you don't have the skills to make it profitable. And, I see that a lot. And even from people who are very successful in single family, when they take the jump to multifamily, it's a completely different game. So a few of the common mistakes that I see, not understanding market rents. So that's a big one, not knowing the market you're in. This happens a lot, especially from people out of town. You get these, areas where, maybe the vacancy in a certain part of the town is a lot higher than the rest. Sometimes like Edmonton, for example, one area can have 1% vacancy, like out in Leduc. You could be in the inner core or Hudson Bay Reserve, Queen Mary Park area where vacancy is still close to 10%. So it's very area specific, the market. You could be missing a major item. Deferred maintenance is huge. It just takes one item to wipe out your entire ROI. Parking lot, roof, boilers, tons of things that can, that you might need to replace while you own the building. Contamination is a big one. We're seeing a lot of phase ones now getting spun into phase twos. Lenders are getting very specific about, contamination from fuel stations and dry cleaners in particular. So environmental contamination is one that I will not touch with the 10-foot pole. If there's a whiff of environmental issue, I just pass on it no matter what. I know a lot of investors who've tried to go this route, and I highly do not recommend it. And not having a reserve fund. As I said, you're scraping together every dollar just to buy the building, and then you find, when you have a couple bad months, you can't, you're falling short. So that's, some of the things I see that newbies fall into. So I kind of think of it as in two ways for multifamily. There's the due diligence that you're doing to validate your deal, and you're also being forced to from the lender. This is a little bit different than single family. They're really going to hold your feet to the fire. And it's not just when you purchase, you have to do this ongoing. So every single year you have to send your bank, your net worth statements, your cash flow statements, a ton of documentation. So they really force you to be a sophisticated investor. So I've come up with a checklist over the years. It's kind of broken up into to 8 different parts. So Elizabeth is going to give a link to this free checklist at the end of the call. But as I've said, my diligence process starts at pre-offer. There's a checklist of things I need to do even before I make an offer. And within 7 days of the contract, after I walk through the property, after I've reviewed the documents, and before the lender approves, before you remove conditions, and before closing. So I have several layers of diligence. I'm going to give you a sneak peek. I don't want to freak anybody out here. So this is kind of the list I've come up with. It's a really good checklist. So when you're going through the purchase process, it's very easy just to highlight these and tick them off as you do them, because it's pretty easy to forget one, and your lawyer may or may not catch this. So these are important things just for you. You know, for ongoing costs, for example, you know, a lot of people don't know this. The ongoing costs after you buy a multi are pretty high, you know, especially if you incorporate. So today, I'm just going to take a sip of water here. I want to talk about reports. So you know, when we buy a single family, we're talking mostly about, you know, appraisals or and home inspections. It's a little bit different for multifamily. There's an environmental component we're throwing in there called the phase 1 environmental assessment. So the appraisals are done mostly for lending purposes. You know, the bank wants to make sure that they're lending in the right value. And appraisals are pretty consistent in multifamily. You know, it's basically, I have it on the next slide here. The lender's going to use, you know, the appraised amount of the purchase price, whichever is lower. So you want to use a mortgage broker to do this. So in commercial multifamily, I highly recommend using a mortgage broker. You know, they have a list of people that they use for appraisers, engineers reports, and phase 1s, and it makes it really seamless for you. They can get quotes and get them probably cheaper than you can. CMHC never used to ask for an appraisal on multifamily. That has just started with COVID, because they used to send their people out to your building. Now they're not doing that anymore. And now I think they've just, you know, switched to relying on appraisers. You know, in the past, they had a large enough database that they didn't need to get independent appraisals. So they use the income and the direct comparison approach. So when you do the appraisal, also ask for an insurance appraisal. It's a very cheap add-on if you do it at the time. And you're going to need this probably every 2 years anyways, as part of your co-insurance clause for your insurance. Phase 1 is an interesting report. You're basically just looking to see that there's no, you know, gas station, dry cleaner. But you might not know that, because they actually go back like as far as, could be 100 years. So you'll get a report with aerial photographs going back. So if there was a dry cleaner or a gas station on that site at one time, this report is going to uncover that. So generally, you know, within 1 square block is what you want to look at. I like to see it a little bit farther than that. I would just say avoid this at any cost. I've asked this question to a lot of multifamily investors. I don't know a single person who's successfully remediated a contaminated site. So if anybody has, I would love to hear the story on that. But as soon as I hear the word contamination, boom, I'm out of there instantly. No ifs, ands, or buts. So I'm going to look at a few case studies with my building. The focus today is on the building condition report. And, you know, when you have a multifamily building or any property, there's one thing that can fix any problem: money. You throw enough money at the problem. You know, you get a roof, you get 3 quotes, you fix the roof. Honestly, that's the way it is, right? Money can bail you out of everything. And, you know, a lot of sophisticated investors fall into this, especially with some of the really high ticket items with multifamily. So the building condition report, it's a pretty comprehensive report. It's different than a home inspection. You know, it's broken down into components like your site information, your roof, balconies, structural, and mechanical systems. So it doesn't include cosmetic upgrades. You know, a lot of people will do like a home inspection on a multi and then try to negotiate a lower price because, you know, the tubs are green or something like that. I've actually seen that happen. So a property condition report, building condition report is a different animal. And at the end of this report, they're going to give you a summary of expected expenditures. So all buildings have deferred maintenance. You know, sometimes it's addressed on the condition report, and sometimes it isn't. And that's what I'm going to go through here. So ticket items like roof, boiler, decks, these are all major items. So the question is what's the probability that one of these items is going to happen to you? So really, we're taking a gamble on when we buy a building. It's not a gamble. We're taking a calculated assessment of, you know, is the roof going to last 10 years based on when was the last time it was done? What does the report say? The boiler systems, the decks, the roof, especially if we're going CMHC, because they will not lend unless a lot of these items are in really good shape. especially now with MLI Select, they're going up to, 50-year amortization periods. Some of these buildings that we're buying, they're 50 years old. I had a building that was 100 years old. So, buildings can be well maintained, but there's always going to be deferred maintenance. So I have a few case studies here I'm going to look at. So this is 3 of the 10 buildings I bought. Just some things that I ran into that, were not flagged on the building condition report and that were gotchas for me. And I want to share this with you guys so that, you're aware when you go through the due diligence process, we can't just rely solely on the reports. There's often things behind the scenes that can be missed. So some things I've caught and some things I didn't catch. So with Adam Apartments, this was the 17 unit we just bought in Leduc. So here's the summary of repairs at the end. They kind of give you an estimate. And I was able to use this to retrade to get a better price simply because I didn't find this on my walkthrough. Usually we'll retrade on the walkthrough. We'll walk through the building, say, okay, it needs X dollars. Does it make sense at this purchase or not? But sometimes stuff gets flagged in the report. So in this case, there was about 40,000 in items. And I don't just ask for a price. I ask the seller to fix the problem. I would rather, buy the building having it already done than having to shell out money and go through it myself. And it's pretty hard for the seller to say, well, you're just trying to get a lower price. It's like, well, no, I just want this fixed. So it's usually effective. So here is one item of diligence. I had to read through all my invoices, basically, that I got from the seller, like a lawyer. And there was one item I caught. It was actually one sentence about the expansion tank on the boiler system that was kind of buried in amongst the documents. So I used this to successfully get a new expansion tank. That probably would have been a $2,000 or $3,000 fix. So that's one example of why we need to read through everything carefully for this purchase, especially when we go to buy the building. Compliance is a big one. So, fire code compliance. Sometimes, I ask for compliance and this is what you get. They give you a certificate from the alarm company that says the alarm system is good. Well, that's fabulous, but that's not fire code compliance. And in this case with Adams, the owner was dragged kicking and screaming to do this. And it wasn't a major thing. There was very little to do to be compliant. I managed to dig up a fire report that's now dated for January. I bought the property in November. That basically said that it's failed. It's unsatisfactory. So after getting them to do it, it was a few small items, like they just had to put door stops on or something, and then the report passed. So it was as simple as that. But it was, sometimes you just have to drag owners to do that. So I don't quite understand that one. So with Chabon Place, this was my 24-suiter. I had, there was about $60,000 of items flagged. It wasn't a huge amount. Any building, you're going to see this at the end on the schedule. Like there wasn't a lot. There was a few items that were outlined. Exterior decks, sidewalk repair. They were recommending replace the boiler system, which I haven't done. But actually, the boiler system is starting to have issues now. So it actually, was flagged. So they kind of give you a 10-year summary. So, they say 2016 is year 1 cost, year 2 cost, year 3. And this is what the lender's going to use for your loan. So if these items are pushed into the 7 or 8 year mark and you're getting a 5-year loan, the lender's probably going to be okay with it if you go conventionally. CMHC, they might flag it and they might ask you to fix these, or maybe they might do a holdback until you do the repair and then they'll give you the money back. I've actually seen that happen as well. So on Chabon, what ended up happening to me is, it didn't take a rocket scientist. You could tell the windows needed to be replaced. Within 6 months, they were leaking. It was freezing cold in Saskatoon. I was replacing them piece by piece. And finally, I just said, you know what, this is a huge problem. I ended up replacing every single one of them. It was a cost of about 25 grand. We also had a very high vacancy period in Saskatoon. So I ended up turning over almost all the units and they were in rough shape. So, my $60,000 on the report quickly ballooned into, probably 250 plus. So the building condition report did help me a little bit, but not so much in others. Now, the most extreme example I'm going to use is another building here. So this was in another one in Saskatoon, Mansard Terrace, great location, right off Broadway, great looking building on the outside. They had just done a bunch of major repairs and I was fortunate enough to have a brand new boiler system. But taking a look at the decks on here. So the engineering report said the decks are in fair and serviceable condition. Fabulous. On the end of the report, it said basically, you know, $3,000 for the fall protection and you're good to go. That's all you need to spend. Well, little did I know, after someone almost fell through the decks, I realized that it wasn't 3,000. In fact, it was 30,000. So, you know, here's the quote I ended up getting for deck replacement. And this is actually what I found when I ripped one of the tops off. So following left to right, this is what we actually saw. So how this did not get flagged on the engineering report, when stuff gets covered up, stuff is literally covered up. So I'm not actually sure, 100% sure how I could have mitigated this, but I should have actually probably gotten more of a reduction at purchase. So kind of following left and then down, they actually ended up replacing, you know, the decking. They ended up replacing the board, the rafters that go into the building, and then the decks, and resurface them. So this was a repair. This is one that was a real eye opener for me. Now, the even bigger eye opener is we had a brand new hydronic boiler system. So there's the before and after. You know, it was a new high efficiency system. But within 2 years, this boiler was undersized. So I ended up blowing through about 70,000 in repairs on this existing brand new boiler. We had to install pumps all over the building to make it work. My power bill was through the roof. Now, just this week, I've actually got a quote for a brand new system for another $42,000 to completely replace this. And this was a new system I got to purchase. So this could easily spin into litigation. I haven't quite figured out how I'm going to navigate this one yet. But these are just a few examples, guys and ladies, of things that can happen, you know, with due diligence that the engineering report may or may not catch. Okay. So the last, I'm going to talk about documentation. You know, there are some unscrupulous sellers out there. Unfortunately, there are questions we need to ask in due diligence, important questions and important documentation that we need. So here's a few of the red flags when you go to buy an apartment building. And I've kind of broken this up into categories. So there's documentation tricks. I've been given fake rent rolls. I've been given rent rolls that are completely fabricated. And when I walk through the building, you discover that's not what it is. Statements, notice to reader statements. You don't get estoppel certificates, which is letters signed by the tenants saying that they don't have a side deal with the landlord. Missing statements, utility statements, old tax assessments. You know, you have to verify every single piece of documentation that you get from the seller independently. Very important. So sometimes, there's nothing you can do about this, but some sellers, they'll move their best tenants to other buildings. You know, I've seen this. So you go to buy it, and then within the first few months, all of a sudden, hey, why do I have 40% vacancy? You know, and they could have had friends and family, and they're paying higher rent than what actually was the market. So this is why you really need a market survey before you buy the building. Or sometimes they'll just fill the building with warm bodies for people that can't qualify. Because there are people that'll pay $1,500 in Edmonton. It's because they can't qualify anywhere else. They'll destroy your building, but you're going to get higher rents for 2 or 3 months. So it's something to be aware of there. Deferred maintenance. This is my all-time favorite. You know, some sellers, they'll replace appliances with old ones. I heard this in Saskatoon. Someone bought a building and there was all new appliances. And the seller actually returned all the new appliances and put the old ones back in right before close because they had all the receipts. You know, it is absolutely unbelievable. You know, they can cover up cracks in the foundation. Hopefully your engineer is going to catch that. I've seen people just put gravel on an old roof and call it a new roof. Failed phase ones. You know, phase one is one that could just put you out of business. You know, that's one that you just don't want to even go near. Boiler issues, you know, or painting over mold. You know, these are kind of things that, you know, inspections will hopefully catch. Compliance tricks. So non-compliance is huge. I mean, fire code, as I mentioned, alluded to in the previous slide, you know, this is one we absolutely must have from the city or municipality. Illegal suites. We want to make sure every suite is legal. It may not be obvious. We can't tell just by the mailbox. You know, we have to go through a higher level of diligence to prove the suites are legal. You want to make sure that your mechanical systems, you know, were well maintained. Have they been looking after it? Or, you know, they didn't provide the shadows, which is like your lawnmower, your, you know, your stuff for the common areas, the stuff that they said they were going to include. So in summary, I hope you guys enjoyed that. It was fairly brief, but it was kind of got the message across, hopefully. As I mentioned, you want to do 2 levels of due diligence. You want to do a diligence on the bank, or sorry, the bank is going to force you to do diligence yourself. So you want to do diligence on the lender, or the lender is going to make you do diligence yourself. And you also want to do it on your own. Okay. So risk is based on your level of experience, your availability of cash to bail you out of problems. As I said, any problem can be fixed with one thing, and that's cash. Risk can't be eliminated, but you always must try to mitigate it the best you can. Now, this just goes incredibly true when you're doing joint ventures. So when you're using other people's money, due diligence is absolutely critical. And you may not catch everything. There's going to be things thrown at you. The hot water tank, I had one hot water tank crap out of me on the first day, even though it wasn't that old. So things happen. You have to be prepared for it. You have to have a healthy reserve fund. So hopefully you guys enjoyed the presentation. That's all I got for now. If you have any questions, I'm more than willing to try to answer anything you guys have. Back to you, Elizabeth.
Thank you so much, Cory. Hopefully you guys enjoyed that. Definitely, I think there's a lot to unpack here. There was a ton of information, and I love that you took like 22 years of real estate investing and distilled it down into basically like 22 minutes, which is super challenging to be able to do. There's definitely a couple of things based on questions and comments that people have had. The first thing I think that's really important is, in order to be able to do your due diligence, you have to ask for all the right information as part of your offer. So someone had mentioned, you know, about clauses. What kind of clauses do you like to see, or would you normally put in an offer to buy a multi-unit that gives you access to all the information that you need in order to fulfill your due diligence process?
Yeah, so on the checklist, if you're able to download the checklist, there is actually a list on there of all the documentation that you need. It's probably 3/4 of one of those pages. So you're going to ask everything from financials, probably within the last 3 years. You want to have any reports, you know, and because they need to do the same reports that you need to do. So you need the appraisal, phase 1 engineering, any work orders that they've done, any invoices, utility statements. You know, there's a whole list of, you know, any correspondence with the city, any correspondence with, you know, police. Oftentimes, I'll actually just get a document where I get permission from the seller to obtain information myself. And then I can just go to the municipality or whoever I need to do, or get my lawyer to do it. So you want this list of documents from the seller within 5 days of your contract. And you want to actually write it in your contract that your due diligence condition, which is generally 30 days after you sign the contract, does not start until you've received all those documents. Because a lot of sellers really dig their heels in to provide this information, especially stuff like their utility statements. But you need to verify everything.
I don't think necessarily that all sellers are trying to hide what they're doing. I think there's a lot of sellers who are just really, really disorganized, and they listed the building without doing their homework and getting all the due diligence documents ready ahead of time.
Oh, 100%. So, I mean, and I've done that too. So I've learned, you know, from my realtors kicking my butt saying, Cory, have a data room ready. So now I have a data room fully engaged. So when someone's buying my property, they don't have to wait. They have to wait 30 seconds and then they get all my documentation. And it's a lot. Like, it can literally be a stack this much. And this is what the lender is going to need to give you the loan. So you have to navigate to the seller and say, look, I'm not trying to be a pain in the butt here, but I need this information to buy your building.
Yeah, I can't get financing. And the requirements from the lenders have increased so much in the last, you know, even just the last couple of years. The documentation that they're looking for, the insurance companies are looking for, everybody's looking for more information and some of it almost starts to get a little bit crazy at some point. But like, I had a situation where it actually paid off, where we bought a building and the sellers had put in a new boiler within the last couple of years. As part of our standard clauses, we asked for receipts on all repairs and maintenance. They gave us all the receipts for the boiler. And then we figured out that there was a grant available. So when we closed on the building, we applied for the grant and we actually got $8,000 or $12,000 back towards a boiler that the sellers had paid for. So it's not just about, you know, mitigating your risk. Sometimes there's benefits and people leave money on the table that they just don't know is available out there.
It's a fabulous, fabulous suggestion. In fact, my boiler example I just had, I'm now going to go do that. I just learned something today. Thank you. 12 grand back. That's awesome. You know, who
Yeah,
can complain about that?
it was a $40,000 boiler that we didn't pay for. And I mentioned earlier, as you were talking about repairs too, I said it's nice to have the cost of repairs included in. So sometimes when we're negotiating with people, we might come back and say, listen, you know, we're not going to ask you to take the money off the purchase price for the cost of, you know, doing XYZ repair. We're going to ask you to do the repair, and then we'll pay you what we were going to pay you before. And sometimes I like to do that because if it's a big ticket item, like a $40,000 or $50,000 job, it's always nice to have it done and get financing based on that higher price than it is to get financing on the lower price and then have to come up with that cash out of your pocket. You don't get it back. You know, potentially you hope to get it back at refi, but maybe not.
Yeah, and you know, Elizabeth, on a roofs, that's a prime example. You know, so many sellers, they try to sell it with a roof that needs replacement, and the lender says no, and that's exactly it. Because then you're going to be coughing up the roof, and then you have to recover the cost somehow. If you can finance based on the repair, that's always better. That's a great point.
Absolutely. So one of the things I wanted to ask you too, I know when we're running numbers for multifamilies, you know, people have a certain amount that they put aside for capital expenses or repairs and maintenance. And it's my belief that newer buildings don't require you to put as much aside on an annual basis. Most of us, though, when we're looking for these motivated sellers and when we're looking at buildings that are listed right now, there's, like you said, a ton of deferred maintenance. There's a ton of issues with the building. What kind of numbers would you be using to say, you know, to build in the level of risk that you're taking when you're buying an 80-year-old building with deferred maintenance?
Well, yeah, I mean, especially people today that are doing the BRRRR strategy. You know, we have all kinds of excess risk thrown at us now because we don't know where interest rates are going to land in 12 to 24 months. I'm stress testing all of my, if I'm doing a BRRRR or a value add on multi, I'm stress testing it at 7% interest rate. So that's the first thing.
Perfect.
So when I'm buying something that's that old, and you have to do a major like renovation, so that cost has to be, you know, factored in. So I'm getting it. So if it's $100,000 a door building, if I'm buying something that needs like that much work, I'm buying it for $60,000 or $70,000 a door. Okay. And even after it's repositioned, I still want to keep that 7.5% contingency for vacancies and ongoing maintenance, because even in an upgraded building, even in a brand new building, you are still going to need to go through probably, the lenders are using $850 to $1,000 per unit per year of basic R&M, you know, on any building. So newer buildings, it's probably less than that, maybe 300-400, but even brand new buildings will still have R&M, right?
Yeah, absolutely. Ash said some landlords may choose to not provide some invoices for repeated breakdown and repairs on poor building elements. If these are kept off his or her books, then that may not be discovered during due diligence. Absolutely. And I think that kind of goes back to what you were talking about, Cory, where there is just some level of risk associated. I mean, this is where the risk in real estate comes from, right? Nobody can guarantee what the real estate market's going to be doing a day, a week, a month, a year, or 10 years from now. And nobody can guarantee when something might or might not happen with their building. I have one owner that we manage for. He closed on a beautiful building that had had virtually no repair and maintenance issues for like a decade because everything had been kept up. The building was in great shape. And then all of a sudden, literally the weekend after he closed, there was a pipe that burst in an apartment upstairs. And by the time, you know, the water got shut off and everything happened, it had flooded down through 3 apartments. That was the weekend he closed. Like nobody could have predicted that. There's nothing he could have done. The challenge you have to do is when you close on buildings like this, you have to make sure that the reserve fund is in place from day one. You can't leave yourself scrimping by and figuring that you're not going to do any major repairs in the first year, because there's just no guarantees that that's going to be the case for you.
Yeah, and the consequences of not having money, and you see it because people turn over suites, they don't have the money to upgrade them, and you can't rent them.
Yeah, and
at least on the prairie. So then your cash flow goes into a death spiral until the building is essentially worthless. And, you know, we've seen that a lot.
Absolutely. And that, if you remember back to our last webinar, I know you were on it, Cory, as well. And Christian clearly said, you don't do major upgrades in the building from cash flow.
Yeah, absolutely.
So we have a number of questions, so let's try and get through some of them, as many as we can. So Sad had asked, what if there is an apartment building already running, but it's near a gas station? From what I've seen, most gas stations are surrounded by residential areas. Should we avoid these types of investments?
It depends on your level of risk. I mean, they built a brand new fuel station here in Kelowna, right, a new Costco one, and there's residential all around it. Now, I don't know what the residential people around there had to say about that. I personally would never go near a building that's near a fuel station. Yeah. Yes, there is lots that are near fuel stations. There's lots in busy areas on busy corners. People make profits, and they're good investments. But they can leak. And when they do, when soil is contaminated, it's a mess. It's a nightmare. And there's absolutely no way to remediate that. Like, that's what I mentioned earlier. I've asked several people. I don't know what's involved in that, but I just wouldn't do it. But there are a lot of people who are comfortable with that. So it depends on your level of risk.
I only know one person who has successfully mitigated a contaminated soil. That was someone in one of my mastermind groups, and he bought an enormous piece of property in downtown Toronto and was doing a huge condo build, and they discovered an oil tank that had leaked into the ground, and it cost him millions of dollars. And the only reason he went through and mitigated the soil was because he had a project worth tens of millions that he was working on. I mean, if it's a smaller thing, and I find that the radius that the lenders are looking at has increased. So before it might have been, if it was within half a kilometer, now they're kind of looking at the radius as a kilometer, maybe a bit more. So
the blast radius. Yeah, absolutely.
Exactly. And someone had asked, how do you estimate when tenant turnover will occur? Which is great. I've been working on a couple of deals with this recently, so I'd love to hear your thoughts.
Depends on the market. Actually, CMHC, the multifamily reports, they've started to come out with stats about turnover. But your best bet for turnover is to ask the property management companies in the area that you're at, what type of turnover are you seeing in buildings? So generally, higher vacancy, you're going to see higher turnover. Here in Kelowna, you're not seeing any turnover because people are terrified to move because we have rent control here, and your rents are going to be 50% higher than you're paying now. Yeah. So if you're in a rent-controlled province, you might have a suite that's 40 years dated, but you don't have to worry about turnover. But if you're in an area like central Edmonton now, where you have tons of competition, tons of incentives, then turnover is, you have to, as long as you keep your unit very well maintained, you can minimize your turnover that way. But as for predicting turnover, I couldn't have predicted turnover in Saskatoon. When I bought the building, it was 5% in 2016. It went up to 20%. And basically all my tenants left to go to buildings that had underground parking and in-suite laundry, and I couldn't compete.
Yeah, absolutely.
So, I mean, that's a one-off. I don't know how I could have possibly prevented that, besides having the reserve fund and having your team of contractors in place to do a suite quickly when it does happen. So that's key. So when you do turn it over, you want to get it re-rented within the next month. You don't want your turnover to cost you any more than it has to.
Yeah, absolutely. One of the things I've noticed as a property manager is that one of the things that dictates turnover tends to be the age of the tenants. So if you have a building that is predominantly young people, they are more likely to have a life circumstance like a job change, or like getting pregnant, or pets or something. They're more likely to take on something like that, which would require them to move to a new unit, versus if your building is predominantly seniors. I have a lot of my tenants who say to me, you're going to take me out in a box. And of course, I always really hope that's not actually the case. But the reality is, older people, retired people, seniors, they are much less likely to move because it's a pain in the butt for them, and it's expensive. And, it's not like you reach a point where you can't necessarily pack and move yourself. So it can
rounders. I call them rounder tenants. So if you ask Terry Peranich in Beverly, he invests in Beverly in Edmonton. Yeah. The rounder tenants, and I have a few of these. These are the guys that are probably in their late 40s to mid 50s. They work at the local auto body shop. They're heavy smokers, and these guys rent forever, and they pay the rent the first of the month, and they never move. Yeah. And these are the guys you want, right?
Yeah. So I think partly you have to look at the demographic of tenants that are actually in the building. And the second thing that you want to look at is factor in sort of a normal turnover. Like I'll look at, for example, we're looking right now at a 20 unit building, and I'll project that probably 80% of the units will turn over within the next 5 years. So then I'll just take, however many units that is, in this case, it would be 16 units, and I'll divide it by the 5 years. And that's kind of the number that I'll use.
That's smart. Yeah, that's really smart, Elizabeth. Yeah.
Thanks. Okay. So Ash said, so Ash is referring back to your presentation, and he said when the debt cost was 30,000 instead of the 3,000 because of what the engineering report missed, does the engineering firm bear any responsibility or cost for the missed item? Is there any way to make them responsible for this?
No, and I don't want to throw Pynchon under the bus. Sometimes when they go there, especially with stuff like roofs, there's disclaimers on there. If it's covered with snow, there's only certain things you can see. And with the example of the decks, I walked on the decks too. I saw like a little bit of missing plywood in one of the sections and a couple pieces of loose railing, and it was covered up underneath. So there's no way even I saw the extent of the damage until we removed that deck. Mm-hmm. Certainly in some circumstances, it could possibly be warranted. With the situation that I'm facing with the boiler, that's a completely different system, different scenario altogether. Mm-hmm. But generally speaking, with the engineering report, that's why I say there's limitations. This is why you have to do your own due diligence and just basically look at the age of something. Like, just because it doesn't say the windows aren't on there, if you can see their aluminum sliders and you can see that they've been leaking, you're probably going to have to replace those. Yeah. Windows is a huge gotcha in multifamily, huge.
Yeah, they're really expensive, but the problem is if your windows aren't in great shape, not only do they increase the cost of your utilities because they allow cold in, but they also leak water, and water leads to mold, and the damage of mold and how far water can travel is sometimes mind-blowing. Like you see a leak over here and it comes out, in an apartment, it comes out in the electrical outlets over here on the other side of the building. So definitely windows. I agree with you 100% on that.
Totally.
Anne has a great question. She said, who is your most valuable team member to help with the paperwork? Your accountant, your real estate lawyer? Do they talk to each other? Who do you get to help you sort through everything? Because when you're buying a multi-unit, like you might be getting, 300 or 400 pages worth of utilities and utility bills and reports and all the other stuff.
Honestly, it's you. I mean, there's different segments. Your lawyers are going to handle certain parts of it, but you can't expect them to handle everything. When the lender's going to hand you this lender checklist, say, Cory, these are the things that you need to do. It's ultimately, this is a huge job. Yeah. 95% of it falls on you. You can't exactly farm it out to anybody else. I mean, your accountant can help you with certain stuff, like if you need to understand the notice to reader, how does a financial statement work? So some people, when they go to buy a multi, they're not used to financial statements, operating statements, balance sheets. So that's the first thing you need to know how to understand statements. So if you want to get help for understanding statements for financials, that's definitely something that you're going to have to reach out for. But a lot of that, it just falls on you. I mean, the property manager, I ask him to look at stuff like, market surveys, validating whether the rents are actually, there or not. That's important. But compliance stuff often will go through the lawyers. Sometimes you have to pull searches and they can do all that stuff for you. Like if you want to know how many 911 calls, how many times were the police at the building, you can get your lawyer to pull those searches. But really, this is something that you can get your real estate agent. So if they've double-ended the deal or you have an agent representing you, you can oftentimes get them to do a lot of this for you to see, or just another set of eyes. You can say, okay, this is what I've gone through, Mr. Realtor, did I miss anything? If they have the experience and they've done enough multifamily transactions, they could come up with something that maybe you've missed. And this is why I've come up with this checklist, because so many times I've missed something. And after the fact, it's like, man, the security deposits were actually not what I thought they were. The seller kind of pulled a gotcha on you there. So this is something that I need to check.
Yeah. And I love that you shared the checklist with everyone. The reality is, for each of us as investors, the checklist should be the beginning of a system or a process that we build, that we repeat consistently for every single building that we're looking at. So the first step in the process is asking for everything you need. The second step is evaluating everything that you get. The third step is chasing down everything that's missing. You know, when you run numbers in the beginning, you might put in 10% for property management. That number shouldn't stay in your spreadsheet until you've actually gone out and, you know, talked to 3 to 5 different property management companies and confirmed that you can actually get property management for 10%. Because if you can't, that number shouldn't stand no matter what you put in there and no matter what someone verbally told you in passing that they got over here. Like, you have to build your systems and processes, and every time you make a mistake, look at it as an opportunity to learn, change your process so it doesn't happen again.
Yeah, see, there's the documentation you ask for and the documentation that you get. There's 2 completely different things. So the first thing you have to do is say, yes, I got the documents. Is this actually what I asked for? So I go back to the fire code example where I got a rubber stamp from the security alarm systems saying the security system is good. That's not fire code compliance, right? That's just one example. So, and this is why you have to go through the documentation risk is big. There's deals that don't close because of documentation, and not just because you can't get it for the lender. Some people just say, no, I'm not getting what I need. I'm going to pass on this project. It can be a reason enough not to buy a building.
Yeah. And I think there's a lot of people, Anne raised a good point in the chat, that, you know, sometimes she thinks you might not be able to afford a cup of coffee. Sometimes in multifamily, it is like that, at least in the beginning, until you get a handle on the tenant vacancy, until you get a handle on the condition of the building and all these different things. So you might be in a position where the first 3 to 5 years owning a multifamily, you're not getting a lot of cash flow. The idea is, in the future, everything will stabilize, your building will be in good shape, you can do your future planning. Okay, I need a roof in 15 years, I'm putting aside money for that, and then things begin to turn around. But I think people closing with the idea of making, you know, thousands or, you know, hundreds of dollars per unit in cash flow per month at the beginning, it's not realistic. Unfortunately, not a lot of people are talking about that, though.
No, all you see is the cash on cash. And I love the coffee analogy. I mean, get used to making your own coffee for the first 3 years. You know, some people will start to pay out their investors because the first 3 months will tick along. You'll have a full building, everything's good, la-da-dee-da. And then all of a sudden you have a couple vacancies. You have a major item. You go to do your first round of taxes for the year. Oh man, you have to pay your property taxes. Your insurance went up. You know, the list goes on and on. My utilities went up. Oh, my reserve fund isn't as healthy as it used to be. It's starting to dwindle a little bit here. You know, but if you've put the work in, I don't want to scare anybody, but if you've put the work in, put your stamp on the building to stabilize it, it will be profitable. It's just the first couple of years is always tight. It just happens like that. It's happened like that with all 10 of my buildings. Yeah. Right. That's just the way it goes.
I would agree with you. I mean, at our max size, I think we had 60 properties in our portfolio, the vast majority of them being multifamily. And we definitely found that it was really challenging, especially if you're anticipating, like, we didn't know what we didn't know when we started investing. I've been investing almost 20 years. So we really thought that we could use cash flow to renovate units and fix them up. But, you know, you get a couple of tenants who move out after 20 years in a unit and they're looking at, you know, $30,000 to fix their unit. And that's not coming out of cash flow.
Yeah, absolutely.
Yeah. Okay. So we still got a number of questions here. Unfortunately, we're not going to get through all of them, but I'm going to grab 2. And if we can plow through them real quick, Cory.
Sure.
Do you ever purchase buildings with illegal suites with the intention to legalize, or do you immediately walk away if there's something that's not legal?
Oh, you just negotiate it on the suite that's missing. So if they say it's an 18 suiter, but it's actually 17, you buy based on 17. And then you do the work to convert it later yourself. You're always buying based on what you're getting. I'm trying to do one with a storage room right now. I'm trying to convert a storage room into a suite, but the city of Leduc is digging their heels in. It may not happen. So you can't purchase based on what you don't have.
Perfect. I love that. And the last one, Cory, you have lots of good books behind you. You're like, Robert Barnes from Viva Fry and Barnes. You have lots of good books behind you. Are those 2 your best recommendations?
Yeah, so Chris Davies' book, Apartment Buildings That Outperform, he talks all about niche. And this is a fabulous book about niche and cash flow and for apartments. I love that one. And the one on my bottom right is, this is Russell Westcott and Don Campbell. This is about joint ventures. So if you want to do JVs, that's a great one. And on top, this is a very unknown book, but it's by Claude and Pierre Boyron. These guys are out of the East Coast. They're commercial realtors. So if you want to know more about commercial, multifamily, industrial, retail, office, this book is expensive. It's probably $200 on Amazon. It's about this thick, but it is an absolutely amazing book. I'd highly recommend it.
Fantastic. Thank you so much, Cory, for sharing your wisdom and insight. And thank you for your time today. We so appreciate it. And for sharing the due diligence checklist, because I know that's one of the goodies in your multifamily course. So I appreciate you making it available to everyone today.
Yeah, I think I gave you the link. I'm not sure if it's in the chat or not, or if you're going to send it out.
I've posted it a couple of times. It's also
okay.
going to go out with the wrap-up email at the end of the week that will have the recording of this as well. And for those people who asked questions that we weren't able to answer today, please do reach out to Cory. And I know you would be more than happy. Let's just pop over here. Here we go. Here's your contact info again. I know you've been super awesome at responding to questions from lots of different people. So I know that you'd be happy to take a few minutes with anybody who reaches out. And
absolutely. Feel free to reach out. I'm happy to talk to anyone, anytime.
Fantastic. Thank you, Cory. And my very next webinar will be coming up on Monday, June 13th at 7:00 p.m. We have Danielle and Candace who will be joining me, and we'll be talking about the evolution of an investment portfolio. So all three of us have built large portfolios of properties, and all three of us are either undergoing currently a change or a pivot, or we are looking to do that in the future. And we're going to be talking about, what does the normal journey for a real estate investor look like? Most of us, we buy smaller buildings, we work our way up to bigger buildings. What happens next as part of the journey? What should you be planning for and looking forward to as part of the evolution? Sounds like, Cory, you could probably have been a guest on that one too, because if you're talking about selling, then obviously you've done some pivoting in your portfolio.
Yeah, it'd be nice to talk about good news instead of bad news.
Absolutely. The question is, what do you do when you refinance or sell a building in the future? What do you do with that? And that's kind of the question that prompted me to create our next webinar. Thank you so much, everyone, for attending. It's been great to see all of you again. Look forward to hearing from you. Cory, really appreciate your time and knowledge and insight. It's been such a pleasure.
Anytime, Elizabeth. Thank you for hosting me.
You're most welcome. Take care, guys. All the best. Have a fantastic week. We'll see you again in a couple more weeks.